Hey, welcome back, Accounting 604. This is now our fourth video in this examination of content from Module 4. Not only are we looking at ROE, not only are we taking a closer look at ROA, but there was another large conceptual topic that we promised that we would look at in Module 4. And you can see here in the title slide, focusing on net operating assets. What are we talking about here, net operating assets? Essentially, what we are trying to recognize as we are disaggregating ROE, disaggregating ROA, is to also remind ourselves that the core operations that really create value is an operating focus, not a financial focus. In other words, it's a focus upon the core operations of the products and services that the company is bringing to market, rather than the adroit and nimble use of financial leverage, or the adroit and nimble use of manipulating your equity base, or any of those kinds of things. It is what is actually going on in the day-to-day operations, and how will that generate future cash flows? How will that generate future profit? How is that being held as really the core of our analysis? And one of the things that makes this very complicated and confusing can be looking at the fact that, and as you see in there in the second bullet point, both the balance sheet and the income statement include both operating and, if we're honest, non-operating items. So you can see here in this slide, what we're trying to do is figure out, well, what components are really operating components, and what are really components that, well, they're not really operational. And so what we are saying is that part of the return that is hidden in ROE, or a component of ROE, is of course the actual operating return from our operations. And in many cases, part of it will be return that is separately earned or separately accrued because primarily of our non-operating activities. So if ROE includes both of these returns, right, really what we're talking about is return from operating activities like sales, sales-related expenses, etc. And then, well, perhaps we are earning a financial return, at least temporarily, from financing and investing. And that's what we want to segregate so that we can focus on the operating activities and returns. For instance, looking at operating and non-operating liabilities, right? You see here that your typical DuPont analysis simply takes total assets divided by stockholders' equity. So in other words, in DuPont, when we talk about liabilities, we're talking about all liabilities, right? But honestly, if you think about the way liabilities are built on the balance sheet, they include a couple of different things. They not only include operating liabilities, you see some examples right there in the orange or yellow, things like accounts payable, accruals, the kinds of things that happen because of your direct operations, but they also include borrowed money. You can see that there. Loans, bonds, mortgages if applicable, right? Interest-bearing types of liability instruments, which you see there, right? Severe legal repercussions versus the operating liabilities, which are somewhat self-liquidating, right? So the operating focus initiative treats these two different types of liabilities quite differently for the sake of analyzing ROE with an operating focus. The same is true, of course, with assets. With assets, we are trying to figure out what is the return on net operating assets. And so you can see there, one of the ways mathematically to calculate RNOA, or return on net operating assets, you see the formula there, net operating profit after tax divided by average net operating assets. And so, first of all, we have to derive from the balance sheet of all the assets that are there, what are the operating assets? And then from the income statement, right, from all of the numbers and sources of income, what is the real net operating profit after tax? So, here are some examples of net operating assets and operating liabilities. This, I just very quickly let you know, this list is not intended to be comprehensive. It is simply representative. And quite frankly, as you've already found out in your homework, some of these labels might be, well, somewhat different in your homework. In other words, there are synonyms for many of these terms, and this list is not comprehensive. But at least some examples of types of categories of assets on the left, things like accounts receivable, inventories, prepaid expenses and supplies, things that will immediately come from direct operations, and then liabilities which will arise from those operations as well, things like accounts payable, accrued expenses, deferred revenue, etc., etc. Some examples then from Pfizer's abbreviated balance sheet here. And you can see there are some items that have been highlighted and others that have not, right? And so some of these items are clearly operating assets and liabilities, and others are not at all operational, but rather derived from finance or activities or investing activities. Here are some examples. Again, this list is not intended to be comprehensive, but you can see here, right, some examples of what we would classify as non-operating assets and non-operating liabilities. You can see these are the very items that, if I flip back to the prior slide, those are the ones that were highlighted, right, and therefore not included in our summation of operating assets and operating liabilities. Some of the examples you see there called out there. Again, this list is not intended to be comprehensive. So here we see totaled up, as opposed to the other previous slide, the textbook does us a favor of totaling up the non-operating obligations, whereas the previous slide here are the operating side. And you can see the non-operating non-operating obligations are certainly much smaller, but they are not insignificant. And so in removing those kinds of things, we get a closer, more focused look at what are the operations for Pfizer actually performing and generating, as opposed to the other contributing factors of finance and investment. So what are some takeaways from this? As you can see on the slide, that the distinguishment or the distinction between operating and non-operating returns really matters. In other words, really the question is, for your analysis, is this return coming from core operations, or is this part of the return coming from financial engineering? Financial engineering is important, but it's the operations that are really sustaining the health and growth of the business. It also means that financial leverage is not one-dimensional. With an operating focus, we can distinguish between operating liabilities and borrowed money. So even there, leverage is not created equal. Not all leverage is the same. And finally, a reminder that net operating assets, that's the true investment base. And the real question is, what return is the enterprise generating on the true operating assets that actually run the business? Or are they generating sizable returns from some sort of financial side bet? So I hope that is helpful. This, of course, is a quick overview. More on this in detail, finer detail in the textbook, as well as in your homework that you will go over. We will see you in the next video.